Hello, and thank you for joining us today for our webinar. Today's webinar is on tax planning with trusts. I'm Nicole Miller, I'm one of the legal directors here, and I'm joined by my colleague Kate, who is an apprentice solicitor. So we're going to go through a couple of tax planning options in relation to trusts, what trusts are, and the sort of most common types of trusts that people use for their tax and estate planning. So firstly, we're going to consider the use and benefits of trusts. The most common ones being life interest trusts in wills, discretionary trusts in wills, and lifetime trusts. We'll also briefly consider the taxation of these trusts and some practical planning considerations for individuals and families. There's quite a lot of information in relation to the taxation of trusts. It wouldn't be possible to cover all of that in detail during this session. So this is quite a brief overview of the tax position. But obviously, if you wanted any further advice after this session, we're more than happy to help clients in relation to their trust and estate planning. Often we're approached by clients to discuss tax planning generally, and they may have been advised or be made aware of trusts either from previous solicitors or advisors, or just sort of searching online on Google and things like that. And they may feel that it's a good idea, whether it's in their will or whether it's as a lifetime trust planning matter. Whether it's the right solution for any given individual will depend very much on their personal circumstances and what they're looking to achieve. So it's really important that before you undertake any planning with trusts that you seek specific, detailed and experienced legal advice on those documents, on those structures, to make sure that you understand what it is you're doing and the long-term implications of using those structures. So firstly, over to Kate for what is a trust?
What is a trust? So I think most people obviously heard of the term trust, but what actually is a trust? So it is effectively a legal arrangement that can be set up by someone either to come into effect either on their death or to run during their lifetime. So the person who has set up the trust will be known as the settlor. And there are trustees appointed to hold legal ownership of the assets, basically, and always for the benefit of beneficiaries. So sometimes the trustees and beneficiaries can be the same people, in which case they would wear different hats, trustee hats and beneficiary hats. And obviously, the trustees will always act in accordance with the terms of the trust as set up by the settlor. So when the settlor set up the trust, they would have had terms that they wanted their trustees to act on, and the trustees should always have guidance in that respect. Trusts are separate legal entities, so they are almost sort of living, breathing thing. It bears its own tax. There are sort of administrative burdens for the trust to do, based on kind of the separate legal entity and the nature of the trust. Trusts can be beneficial because it allows for trustees to have control over how the assets are used. So often if the settlor doesn't want assets to pass outright to a beneficiary, it can be a useful tool. They will allow the trustees to run the trust, say, in favour of the beneficiaries, but they've set out those terms that assets aren't going direct to the beneficiaries. Again, it's flexibility, that's the key point. So the settlor then has flexibility because they have entrusted the trustees to look after the assets, and they can have flexibility based on what the circumstances are right for at the time. So a beneficiary at one point, may be able to receive a capital sum, but further into the future, that may no longer be the case. So the trustees can kind of manage the circumstances on a case-by-case basis and do with the assets, what the right thing is at that time. And it's also a useful tool, sort of strategic planning tool for tax and succession purposes, which we'll kind of go through in a minute.
So why use trusts in tax and estate planning? Trusts remain a core part of estate planning for many individuals looking to protect their wealth, manage their tax exposure, and also to control how assets pass to future generations, either during their lifetime or on death, as Kate was just saying. And despite sort of the ongoing changes to the rules around tax planning, trusts are extremely relevant when used appropriately with clear objectives. And as I said earlier, it's important to make sure that trusts are right for you, especially with the ongoing changes in relation to the taxation and use of trusts. In particular, lifetime trusts allow individuals to transfer assets out of their estate whilst retaining that element of control if they want to be trustees, and also the ability to benefit future generations. So it might be that they are sort of keen to start their estate planning, but they're not entirely sure who they want to receive those funds or at what time. And likewise, will trusts allow the testator, that's the person who's preparing the will, to leave their assets in a flexible way on their death. So the trustees can consider the circumstances at the given time when they're looking to then administer the trust. So there's a number of benefits depending on the nature of the trust and the way the trust has been drafted. As I said, there's a couple of different types of trusts out there. We're just looking at the key ones today, but depending on what type of trust it is you're using, the benefits might change, the taxation might change. So it's really important to understand sort of your particular trust. But some of the key benefits are to reduce or manage the tax exposure, as often trusts are used with a view to mitigate inheritance tax, like I say, making that gift to reduce the size of your estate, get the assets out of your estate at this point now, but preserving the family wealth for future generations and controlling the future distribution of those assets across family lines and generations whenever the funds are needed by those individuals. It's also a very important way, depending again on the nature of the trust, to protect the assets within the trust from potential bankruptcy, divorce, and other financial proceedings of the beneficiaries. So an individual can set up a trust, they can put some assets into the trust, it gets those assets out of their estate, but it doesn't belong to the beneficiary, as Kate was saying earlier. So if that beneficiary, one of the named beneficiaries, then faces a divorce or bankruptcy, those funds are not part of their estate for those proceedings. So it has that asset protection available to them. Obviously, if the funds have been appointed out of the trust, then that's a very different situation, but all the while it's still in the trust, just being applied for the benefit of that beneficiary, those funds are protected. And it also provides a great deal of flexibility depending on the trust that's being used, where the future needs can't be predicted at this time. So if you're not sure who you want to benefit, which of the children or grandchildren might need the funds the most, what their position is going to be sort of in 5 years' time, then by putting the assets into the trust, you've got it out of your estate, but those sort of circumstances can be kept under review as time goes on to make sure that they receive those funds when they need it and in the way that they need it most. So rather than actually giving the funds to them outright, it might be a case of applying it for their benefit, paying school fees, contributing towards a property purchase, or buying a property within the trust for one of the beneficiaries to live in. Just sort of a couple of very brief examples. So now we're going to look at some of the key different types of trusts that we mentioned earlier.
So life interest trusts in wills. So that is a trust that is set up by someone's will. So it will come into effect on their death effectively. So they're becoming quite popular now, and they're particularly popular for blended families. Essentially what a life interest does is it provides that the life tenant, which is the beneficiary of the trust for their lifetime. So say you have a spouse who has created a life interest trust in their will. The first spouse has passed away, they were the settlor, and the surviving spouse is the life tenant. They would have the right to the income for that trust for the rest of their life. So often the life interest trust falls over the property. So the property will be held in trust, and the life tenant has the right to live in that property for the rest of their life free of rent. They obviously need to upkeep the property, but if that property were to be sold in the future, they would have the right to the income of the sale. Say it was invested, or say the property was rented out, the life tenant would have the right to that income and for the rest of their life. Essentially the purpose of the life interest trust is, whilst the spouse can use that trust fund and have the right to the income, the capital is preserved essentially for what we call the remainder men. So this is where it's popular for sort of blended families. So say you have a spouse that had children from a previous relationship, they want to ensure that their spouse is looked after beyond their death. Their wife or husband can live in that property, but what they want to avoid is the surviving spouse doing their own will and passing on those those assets to someone else, and their children being left with nothing. So the remainder men would be the people who are to receive the capital from the trust once the life tenant has passed away and the trust has come to an end. So we just set out some advantages and disadvantages here of a life interest trust. So let's say the advantage being that it protects the capital for the remainder men. We would expect the capital to grow, and the trustees would need to look after the trust. So say, for example, the life tenant wanted to move, the trustees would review and say, well, is the property that they want to move into a suitable, a trust investment for the trust. It provides for the life tenant for the rest of their life. So they have the right to live in that property, they have the right to the income, and hopefully that income would be enough to service their expenditure. So, you're not leaving a spouse or a trust beneficiary kind of without. It includes the flexibility to pass capital to the life tenant and or the remainder men if they need it. So if the trust is is quite, a large pot, and the life tenant doesn't need all that income for the rest of their life, they've got enough of their own funds to kind of deal with their expenditure, then the trustees can make the decision to advance capital. So say we have an investment and one of the remainder men is actually, experiencing financial hardship, there can be a decision between all the trustees and those beneficiaries to kind of advance capital to the remainder men and whilst the trust is still ongoing. So it's nice and flexible in that regard. And there's nice, clear and predictable tax treatment, as the life tenant is effectively treated as having inherited the trust asset for inheritance tax purposes. Okay, so some of the disadvantages, however, is it's not as flexible as a discretionary trust, which we will also go through. There is some flexibility that can be included, such as advancing funds, and we would always recommend anyone that does a life interest trust do a letter of wishes that sets out exactly, what they intended for the trust, but it's just in its nature is just not as flexible. And also the tax treatment for inheritance tax purposes. So the trust fund itself actually aggregates with the estate of the life tenant on their death. So say we have a life interest trust over a property, the first spouse has died and the share passing into the trust is worth £150,000. That's treated as an asset of the first spouse for inheritance tax purposes. Obviously passing between spouses, it would pass tax-free, but it means on the second death, we would need to calculate the interest of that trust fund and include it as an asset of the life tenant's estate effectively. Obviously that asset might have grown. So you would expect some capital growth throughout the trust period. To say it's grown to 160,000, you've got £160,000 asset there in the life tenant's estate, which, as I say, between spouses is not a huge issue, but there could be kind of adverse tax consequences on that point for inheritance tax. So it's just worth bearing in mind. So just kind of drilling down a bit more on the sort of taxation point, as I say, it's taxed when the testator dies in the normal way. Again, often spouse exemption applies. We've just covered that it aggregates with the life tenant's estate on their death. So as I say, it's often subject to inheritance tax at that point. And then there could be what we call a potentially exempt transfer, which is a PET, if the assets are advanced to the remainder men, the kind of remaining beneficiaries during that lifetime. A PET is essentially a gift, so the person giving the gift would have to outlive that gift by 7 years in order for it to fall out of their estate. Hence why it's called potentially exempt, because if they do outlive, then it's not a kind of taxable gift of that nature. There's income tax to consider. So if the trust funds are invested or the trust property is a rental property, that is income that would need to be declared to HMRC and income tax paid on it. Often you can mandate the income to the life tenant, so it's effectively bypassed by the trust and it's just directly mandated to the life tenant, and it's treated as if it's their income and it would be dealt with as part of their kind of own tax affairs. But if the income is not mandated to the life tenant and it's taxed in the hands of the trustees, they can then provide the life tenant with what we call a Form R185, which is a form submitted to HMRC, and the life tenant might be able to reclaim the tax as appropriate if, depending on their own sort of tax scenario, if they would not have paid income tax themselves, then they can claim that back. And there's also capital gains tax points. So any capital gains that is taxed in the hands of the trustees is currently taxed at a rate of 24%. Obviously, there's an annual exemption. That's often limited to half of an individual's allowance. So that's currently £1,500 for 25-26, with CGT allowances recently being lowered. But there is a free CGT uplift on the death of the life tenant. So
now I'm just going to look at discretionary trusts. So this is sort of a different trust structure. Firstly, I'll look at discretionary trusts in wills, and then we'll look at lifetime trusts as well. So a discretionary trust provides the trustees with complete flexibility. Although, as Kate said earlier, they're often sort of guided by a letter of wishes that the settlor or the person that's creating that will would prepare when they prepared their wills, explaining the reason for setting the trust up and sort of the way they anticipate the trustees using the funds. The trustees themselves do have complete flexibility as to how the funds are applied. This means that although you'd have a class of beneficiaries, there might be sort of 5 or 6, 10, 20, however many beneficiaries in that class. None of those beneficiaries are entitled to a single penny from the trust. They just sort of have a hope that at some point the trustees will appoint some funds, whether it's capital or income, to them for their benefit. But it's down purely to the discretion of the trustee. So ultimately the trustees decide which beneficiaries can benefit from the trust, at what time and to what extent. These trusts are often used where potentially the sort of young family members, vulnerable family members, or those that might be sort of financially immature. So the testator, like I said, the person that's created the will, puts the discretionary trust provisions in their will, and then states who the beneficiaries should be, the potential beneficiaries should be, and the trustees can then consider the testator's wishes, which are hopefully set out in a letter of wishes, along with the ever-changing set of circumstances for each of those beneficiaries. And this just gives those trustees that long-term control after the testator's passed away. With the discretionary trust, the provisions in the will are sort of quite specific in terms of how the trust should be used, but there's no sort of real flesh on what the wishes are. So the letter of wishes allows the testator to set out all of their wishes in a lot more detail than you would anticipate being able to include in the will. And it can be sort of as detailed as needed. So it could say that if in this particular circumstance, this particular set of sort of scenarios, I want you to do this. And if on the flip side, this is what's happening, then I want you to do this. So for some, they want to set out that if the estate is worth more than a particular threshold, they want these wishes to be carried out. And if not, then they want these other wishes to be carried out. Likewise, you could say that you only want particular beneficiaries to inherit if they've sort of established their own careers, or they've got to a particular point in their life where it's appropriate for them to receive those money, or that they absolutely should not receive anything from the trust if another particular set of circumstances has arisen. So it gives, like I say, complete flexibility as to how those funds are used, and it allows the trustees to really consider the circumstances at any specific point in time. Often when someone's preparing their will, they're not planning on dying sort of in the short term, so it's quite hard to predict sort of right now how those funds should be applied and what the circumstances are likely to be in potentially sort of 10, 20, 30 years time. Although we always suggest that people keep their wills under review, that's not always the case, and people don't necessarily think about coming back to update those documents. So if they haven't, it has got that flexibility. And it might be that there's sort of particular assets within your estate that you want to sort of manage in a particular way. So if you've got business assets, then perhaps your wishes in relation to those would change depending on what the position of the business is at the time of your death. If you've got sort of particular areas of land that you might be getting sort of planning permission on and things like that, again, your wishes might differ depending on whether you've got those that planning permission or any sort of development going on. The advantages, as I say, complete flexibility. That's the sort of the key advantage of the discretionary trust. The trustees can look, and if someone's about to be made bankrupt, for example, then they wouldn't think to be appointing funds out to them. If they're about to be made get divorced, again, they wouldn't be looking to appoint any funds out to them at that point. But once those risks have then passed, then funds could then sort of start being applied for their benefit. So complete flexibility, but also asset protection if that's needed as well. And as I say, the trustees can adapt the application of funds depending on what all the circumstances are. So yes, beneficiary needs are something they can take into account, but also the tax changes that might occur over the coming years between now and when they pass away. At the moment, a key disadvantage of a discretionary trust is it is not very tax efficient, and I'll sort of talk about the taxation point in a moment. But that might change as time goes on, and it might be that actually you can get some tax advantages by making some payments out of the trust whilst keeping sort of some of the assets within the trust. A particular sort of key point that we have at the moment is in relation to the residence no-wake band. And if the assets are in the trust, you wouldn't qualify for the residence no-wake band. But if you appoint funds out of the trust within a 2-year period, then you might be able to qualify for it. So it gives that complete flexibility for the trustees to work out what the tax position might be following the death of the testator, and then apply the funds accordingly. So flexible, and often the flexibility and the benefits outweigh the tax burdens, but the tax side of things is something that very much also needs to be considered. So as Kate was saying earlier, the trust itself is its own sort of separate entity, and it has its own tax burden, and a discretionary trust falls within what we call the relevant property regime. So that's sort of the set of tax rules that apply to it. So from an inheritance tax position, the estate of the testator is taxed in the normal way when they die. So all of the assets within the estate are taken into account. Any sort of allowances are offset against the value of the estate. Any exemptions that might sort of apply for any sort of small sums that are paid out are then taken into account. The tax is paid, and then everything else then passes into the discretionary trust that's then in the will, or sort of whatever the terms of the will states. But the trust itself then wouldn't qualify for any exemptions such as the spouse exemption or the charity exemption, because the trust itself is not benefiting a spouse, it's not benefiting a charity outright. So there is potential that you would lose some of the exemptions and some of the tax benefits there. But as I said a moment ago, if assets were appointed out of the trust within 2 years, then there's a sort of writing back provision, which means that we can sort of treat the will as if it had always paid the funds directly to that spouse or that charity. So there's sort of the benefit there of being able to consider the circumstances and still get those exemptions if appropriate. Also, as I said a moment ago, the residence no weight band, the estate would lose the residence no weight band if everything passes in to the discretionary trust. Not everyone qualifies for the residence no weight band anyway, so it might not be too much of an issue. But if the deceased circumstance was such that they would qualify for the residence no weight band if some of the funds were appointed out to the trust, then the trustees can arrange that within that 2-year period to make sure that that allowance isn't lost. As I said, it falls into the relevant property regime, so the assets within the trust after that 2-year period are subject to inheritance tax charges on an ongoing basis. So there is a 10-year anniversary charge on each 10-year anniversary of the deceased's death, and there's also a tax charge whenever assets leave the trust. This tax charge, whether it's the 10 years or when assets leave, is at a rate of up to 6%. So it's not the normal 40% rate that applies on death. It's a much lower rate, and it will depend on what the available nil weight band is for that trust at any given time. So at the 10-year charge or at the point when assets are leaving the trust. So although it isn't sort of that great from an inheritance tax point of view long term, the rate of 6% is a much smaller sum than the 40% rate, and the flexibility that the trust offers normally outweighs that sort of drawback on the tax side of things. And part of the reason why it is subject to this tax is because the assets within the trust don't belong to anyone's estate. As I said, no beneficiary is entitled to anything from the trust itself. So there's no one that the revenue are going to get the sort of money back on when someone passes away of the funds being within their estate. So we have this ongoing tax charge instead. Income tax and capital gains tax, sort of again, it's its own structure for that. So income for a discretionary trust is taxed in the hands of the trustees, and it's at the highest marginal rates at the time. So again, this sort of subject to change as time goes on, but currently sort of quite a high rate. But in a similar way to what Kate was saying earlier, if the income is appointed to a beneficiary, a Form R185 can then be issued by the trustees. So the beneficiary can reclaim some of the tax if that's appropriate, depending on their personal tax circumstances. Likewise, depending on the terms of the trust, it might be possible to execute a deed of appointment so that any future income is mandated to the beneficiary, and then it's treated as belonging to the beneficiary in a similar way to the life interest trust. But to ensure that the trustees sort of retain that flexibility over the income, it's normally recommended to use a revocable deed of appointment so that at any point in the future, the trustees can then revoke that entitlement to the income and maybe apply it to someone else or keep it within the trust itself. Capital gains tax, again, very similar to the life interest trust provisions in that capital gains are taxed in the hands of the trustees at a rate of 24%. And again, the annual exempt amount is limited to 50% of the individual's allowance. So at the moment, £1,500, which is sort of quite minimal. The one benefit that a discretionary trust has is holdover relief, which is in relation to capital gains tax, which means that as assets are appointed out of the trust, it might be possible to hold over the gain. So the trustees don't pay the gain on the assets passing out of the trust, but instead that is held over and the beneficiaries receive the value of that asset as the sort of the value when the person that passed away instead. So it has that potential advantage. Looking at lifetime trusts now, those ones we've spoken about are all sort of ones that are generally created on death, but a settlor, this is the person that sort of creates a trust, can also create discretionary trusts and life interest trusts during their lifetime. The inheritance tax implications of creating a trust is that the creation of the trust is normally treated as what we call a chargeable lifetime transfer. So where Kate mentioned a moment ago about a potentially exempt transfer, a chargeable lifetime transfer is immediately chargeable to inheritance tax at a rate of 20% if the value of that gift exceeds your available nil weight band. So although the 7-year rule still applies on the sort of top up, the additional 20% that would be payable on death, there is that immediate charge that is paid if you're putting more than your nil weight band into the trust. And again, the trust, whether it's a discretionary trust or a life interest trust, would then fall within that relevant property regime that I spoke about a moment ago. But the important thing to note is that the trust itself is not subject to inheritance tax on the death of a beneficiary, because it's subject to that relevant property regime instead. So sort of a bit of a summary here about lifetime trusts. Why create the trust in the first place? So it removes any growth from the estate, which is good for early inheritance tax planning, and also freezes the value of the assets in the estate for that 7-year period, and any growth is then outside of the estate. So if you've got sort of an asset, whether it's sort of investments, whether it's a business share, whether it's land that's going to get development potential and stuff like that, you transfer the asset at the low value into the trust now, and then any increase in that value is not inside your estate going forward. Really good asset protection for the reasons we've spoken about before, and allows succession planning at an early stage. And it starts that 7-year clock. So even if you're not sure who you want to benefit, which beneficiaries you want to benefit and at what time, the assets are out of your estate. And then it then sort of starts that 7-year clock ticking. And the settlor can be a trustee as well. So it allows the settlor to stay in control of those assets for the rest of their life, all the while that they are a trustee. So it has that benefit. And a potential capital gains tax benefit is holdover relief. So as I was saying a moment ago about being able to hold over gains going out of the trust, you can also hold over gains when you're transferring assets into a trust. So that has the potential advantage if you perhaps wanted to give it to an individual, but there was going to be a large capital gains tax liability. Instead, you're then getting that capital gains tax freezing and holding that gain over instead. Disadvantages are that you cannot benefit from the assets that you're putting into trust. It's the same with any lifetime gift. For it to be effective, you can't benefit from those assets. And if you're creating a trust and you've got children, then your minor children cannot benefit from the trust until they reach the age of 18. So that can be a bit of a drawback. It just means the funds have to be held in that trust until they reach that age. If these rules aren't met, then the trust would be settlor interested, which can have a negative impact for inheritance tax purposes and income tax purposes. There's that immediate charge to inheritance tax that I mentioned a moment ago, depending on the value in question, and also the relevant property regime is not ideal from a tax point of view.
And finally, there's something called a bare trust. A bare trust is the most simple form of trusts really that exists. Bare trusts are created all the time, and it's essentially a trust where your trustees are holding it for someone else on the trust that they'll distribute to them. So it's a simple and transparent structure, and essentially, as I say, the trustees hold the assets for a named beneficiary. So it is a fixed trust. So the beneficiary does have an immediate and a fixed entitlement. So it's not like the discretionary trust that we talked about. There's no kind of discretion. It's for that beneficiary, and they would have access to those funds if they wanted to. The trustee is merely a nominee, really. It's important to consider when to use the bare trust. So it is tax efficient for gifting, as I say, so it's that potentially exempt transfer. It is treated as an outright gift again, so it is a pet. You'd have to outlive it by the 7 years. The assets are treated as if they belong to the beneficiary for IHT, CGT, and income tax purposes, and so it's often taxed at a lower rate for that reason. It's particularly useful for making gifts to children, especially if they're kind of minors, for example, but it does need an adult trustee to hold the assets. One of the benefits is that you can retain an element of control. So you have a minor beneficiary who can't receive the funds until they're 18, then they would not be able to receive those funds until they turn 18. Quite a common one, for example, is like a children's trust account with a bank. A grandparent might own it, but they're holding it on bare trust. So when the child turns 18 or whatever, they will receive that fund, and the children have the access to that fund for kind of any future needs. There's no ongoing flexibility, however. This is not something that's normally accompanied by like a letter of wishes. It can't be changed. The beneficiaries can't be changed. Once the beneficiaries are set and that trust is set up, then that's kind of fixed. And as I say, the beneficiary is absolutely entitled to the trust funds. So they will be able to access that. There's no kind of discretion there as to whether they could be based on circumstances at the time. Once the bare trust is created, then that's it. They have an absolute entitlement. So there's obviously quite a few trust structures in place. So one of the key questions to ask yourself, which is the right trust for you based on the circumstances. We've just listed some things to kind of consider here. So what is more important, certainty or flexibility? Don't underestimate the value of flexibility. Lots of people want to make decisions based on tax treatment, but actually based on their circumstances, flexibility would probably be better for them. Is control needed now or in the future? So is this something that you're intending to create on death and that you want to kind of control those funds, or your trustees to kind of have the flexibility to control those funds beyond to kind of your grave? Who you want to benefit, how and when. If you envisage those beneficiaries changing, then a discretionary trust, for example, would be appropriate. And what are the tax implications going to be? That's definitely something to consider, especially as like CGT rates and that change. You also need to consider your own kind of affairs. So your own will, it's always sensible to keep that updated. Lasting powers of attorney, anything can happen. You could lose capacity. What would happen to the trust fund then? Kind of wider estate planning matters and other trust structures you already have in place. So you may have set up a trust many years ago, for example. You don't want any newer trusts to kind of contradict that. And also keeping an eye on any lifetime gifts you've already made. So you might have already made gifts that have started the 7-year clock. Are future gifts into trust going to have an adverse consequence on that? And we just said here that although tax and estate planning are often key considerations, they should not be the main driver. So it's just something to bear in mind.
That's pretty much all we've got time for today. Like I said, it was a bit of a brief overview of the different types of trusts and the taxation of them. If you've got any questions, then feel free to pop them in the chat now. Otherwise, we've got our contact details up on this slide. So if there's anything that we can help you with at any point in the future, please feel free to get in touch with either of us, and then we can assist you where needed. Thank you for your time.
Thank you. Thanks so much.